Guys, Apple just reported. I want you to see something before I explain the numbers. Down 4.5%. Here's what they reported. Estimates for $1.27 in EPS. They reported $1.29. That's beating by 2 cents. Revenue is expected to be 88.8 billion. They reported 90.15, beat on revenue. It is now down 5.3%. It beat on both numbers and is down. Guys, the mood has changed on Wall Street. The mood has absolutely changed on Wall Street. We've been saying for a while that Apple, we feel, will be the last one that everybody has to give up on before we see a bottom. We're nowhere close to that right now. I'm pretty sure that Warren Buffett's going to start buying now. I think my guess is he was buying sub 140. Does that mean you should? No. Do your own research. But the point I'm trying to make is, just a couple years ago, last year, bad news, stock soared. Why? Because it kept Fed rates low. That's what happens in the mood as the pendulum swings. Mo and I have been talking about this for a while. Mo, what do you got?
So the iPhone is everyone talked about it going in. CNBC all over this morning. Well, it depends what iPhone's going to do. It depends what their revenue is going to do on their new phones. 42.63 billion in revenue versus 42.67 billion estimate. So it just barely missed, and the people are pissed.
That, guys,
it's such a small thing. If that happened a year ago, ignore. Close enough.
That's what happens in the moods of the market. That's why Mo and I, as value investors, we don't look at short-term results. We care about a long-term business. I always ask 3 questions. 1, do I think this company will be around in 10 years? With Apple, absolutely. 2, do I think the company will be more profitable and have more revenue in 10 years? The answer is yes. 3rd question, can I buy it for a reasonable price to pay that gives me a security of capital, not a permanent loss of capital, and an ability to make a good return? And that's what we're going to do here in a few minutes with our stock analyzer tool. But in the meantime, the idea here I'm trying to explain is one that took me a long, long time and was hard for me to understand. And I'm sure, just like I was, you're probably in the same boat right now where you're sitting there saying, I don't get this. Sometimes I don't either, guys. Mo would tell me last year, this market makes no sense. I've now gotten to the point where I can laugh at that saying, you're right, it makes no sense. And that's a good thing, because your job as a long-term investor is to take the market's irrationality and make good investments from it. And it's hard sometimes, but guess what? That's why I'm here, and that's why Mo is here, to hold your hand along the way. Don't follow the hype. If you told me this morning Apple was going to beat on revenue and EPS, I would have said, oh, it's going to fly up to 160. Yep. And it didn't. Nope. It's now down. Well, now it's rebounding a little bit. It's only down 3.7%. Okay. But that's what I'm trying to encourage you to do. We do earnings reactions all the time. We do 2 or 3 videos per day without earnings reactions. Please subscribe to the channel if this makes sense. And if you want to learn how to properly invest your money, then you have to keep listening to us. It just makes perfect sense. So let's go see what Apple looks like. Go ahead, Mo.
They missed on iPhone. They missed on service, 19.19 billion versus 19.97 billion. Beat on Mac, 11.51 billion versus 9.25. That's a big beat. That's a wearables, big beat. That's watches, etc. 9.65 versus 8.8 billion. iPads beat there. I'm sorry. No, they missed there. 7.17 billion versus 7.81. If you're a Twitter person, can you please get your math right, beating and missing? Because you guys keep getting this wrong. This person wrote beat even though they missed on iPad.
Yeah, we had that today happen.
We had that yesterday?
No, it was today.
Again, but it was yesterday too. Yeah.
Oh. So, guys, if you're new to the channel, we have an 8-pillar process. It lets us use, and by the way, if you join our community, and you're part of our community,
it's down less than a percentage.
Now it's back up to even.
Yeah. So, guys, this is the irrationality.
So something they said in some sort of report or call makes them. Oh yeah, look at this. Oh my God, it's almost even now. Yep. Guys, in this call, okay, now it's down 1.5. In this call, it's gone from. We started the call at like 3.7 in this video. I mean, went to like 6, went back to. I mean, almost even. This is what makes the market irrational. You're telling me in the last hour, in the last 20 minutes, the last 10 minutes, Apple's lost and gained 5% of its value? No. That's irrational. And that's the hard part about investing. It's taking the emotion out of it. It takes 3 things to be successful in investing: mentality, emotion, and process. We have the process. We have the mentality and emotion, but learning that takes time. And that's okay, but you can do it. So our 8-pillar process. Our users will be able to edit these 8 pillars here very shortly. But we have our 2 X's here, valuation numbers, the 5-year PE ratio, and the 5-year price to free cash flow. We actually like all these other ones. I don't know if I like the shares outstanding. They're buying back a lot of expensive shares. I don't really like that a ton, but I get it. They spit off a lot of cash. It's kind of hard.
Gotta do something with it.
They pay a petty dividend. Do they even pay a dividend next year? I don't even know.
I got a question for you. Why do you think they buy back expensive shares like that instead of paying a bigger dividend? Because if I'm Apple,
because people, it's easy. It's an easy way to manipulate EPS. I don't like that, but it's an easy way to manipulate, and it's tax efficient.
Okay.
So think about it. Even if you're buying back expensive shares, you're still decreasing the number of shares outstanding, so you can artificially inflate your EPS.
Yeah.
I don't like that. It's a bad use of our capital, though, as investors. If you're an investor in Apple,
it's surprising to me that they wouldn't increase the dividend instead, just to attract more people to their stock.
Yeah, you might be right.
That's kind of the thing.
Well, it's easy. It's easier to stop a stock repurchase than it is a dividend. The dividend yield is so public.
Yeah.
The stock repurchase, people are like, "Oh, okay, cool." I mean, look at Sleep Number. I didn't even notice.
Yeah, nobody noticed. Yeah.
And then Gary sent us the email. He goes, "Look at this." I'm like, "Oh my gosh, they stopped the stock repurchase." No one cares. Right. All right. So the question is, are these all good enough? And if the company is growing at a fast rate, then maybe you can justify this or has a high moat. I think Apple has a very good moat. Let's see what analysts are saying about Apple growing. So guys, not very much growth rate here.
I'm actually quite surprised.
Mid-single digits on EPS growth, okay, for the next 4 or 5 years. And revenue, low single digits. This is not a high revenue growth business, guys. Why? It's so freaking huge.
$2.34 trillion.
Don't worry about that. Look at the revenue.
Yeah. Well,
because the revenue is going to drive all that.
Amazon was around this type of revenue, and then they went
yeah,
to
but when we're looking at growth
trillion.
numbers to affect things, we have to look at the revenue growth numbers. That'll drive the market cap growth numbers.
Correct.
So that's why I don't care about it. Listen, if the company was a $1 billion company and had a $2 trillion valuation, $1 billion in revenue, has great growth potential, it doesn't justify the valuation. Here, we have a $387 billion revenue business, right? Mm-hmm. And if you do what would they do, 90 billion? Yeah, that's hard to grow. The market's going to dictate whatever the market cap is.
Right.
And by the way, I'm glad you guys are seeing this because these are the conversations that Mo and I have in my office, in his office, around the office, where we just talk about these things. But it's hard to grow this number. It's such a huge company. So let's use Stock Analyzer tool. All right, revenue growth numbers. I'm going to do a low, middle, high, 10-year analysis. Mo, do you want to help me?
Sure.
I bet you're going to go higher than me on this one.
I bet I am. 4, 6, and 8. Where
are you getting 4 from, Mo?
Well, let's go here. I like to go on the low side, just really low.
No.
Why not?
This is the high side for analysts is 5%. I was going to do 2, 4, and 6.
So for me, I look at this and I don't think that a lot of analysts are putting an expectation on.
You do your analyzer, I'll do mine. So guys, I'm doing 2, 4, and 6% revenue growth because I look at it going, you have to crush it to do 6%. They did okay. So profit margin.
What are you going to put in?
I'm going to do 20, 22, and 24.
Okay.
Free cash flow, I'm going to do 22, 24, and 26. PE, I'm going to get assassinated here in about 14 seconds. Guys, I'm here to make conservative assumptions. And from there, my desired annual return.
What's your return? I'll put the same return.
12, 13 and a half, 15.
Okay. All right.
Hit the analyze button. My numbers. I have a low of 55 to 60, a high of 80 to 85, a middle price of 66 to 72. We're probably pretty close to each other.
Mine's 65 on the lowest end, 101 on the highest end, and a middle range of about $80.
In full disclosure, Mo has a mad bias for Apple.
I do, but I don't think a lot of people are putting enough emphasis on the subscription business that they can get going.
You might be right, but Mo, 6% would double them in 10 years. They'd be at $770 billion in revenue. It's a lot. I
don't think it's completely unreasonable.
I mean, to have these kind of margins, I don't know. You're right. Subscription. You might be right. But Mo, remember 10 years ago with Microsoft, I didn't expect this revenue growth at Microsoft. 5 years, 6 years ago, somebody came to me and said, Paul, what do you think about Apple? I said, listen, Apple's a value play. This was 5 or 6 years ago. It was selling for like 9 or 10 times earnings. I'm like, but can you keep this revenue growth going? Boy, was I wrong.
Yeah.
It actually did better revenue growth than I expected. So you're right.
And for those of you, when I keep saying subscriptions and the profit margin, you're going to have a lot more profit. You're going to have a lot more margin on a subscription to Apple Music, Apple TV, whatever, than to an iPhone or a MacBook or whatever.
And Apple's back. It's even. It's even.
Want to know why?
Why?
Subscriptions.
So guys, I need you to subscribe to this channel. Trust me when I say you're not going to want to miss all these. Every earnings season, we do tons of video. We stay here. We record the videos and they're out within 10 or 15 minutes. Thank you very much for your time.